Hello, everyone, and thank you for joining us today. My name is Chelsea Chartrand, and I'm joined by Derek Duca. We're wealth advisors at CI Asante Wealth Management based here in Oshawa. We really appreciate you taking the time to be with us today. Today's session is all about tax-smart retirement income, and more specifically, how to keep more of what you've worked so hard to build. One of the biggest surprises many people face in retirement is that it's not just about how much you've saved, it's how you draw it down that really matters. Taxes can have a significant impact on your retirement income. They can reduce how long your savings last, affect your eligibility for government benefits, and in some cases, create unnecessary income spikes. The good news is, with the right strategies, there are ways to manage, reduce, and even defer those taxes over time. So in today's webinar, we're going to walk you through how different sources of retirement income are taxed, strategies to withdraw funds in a more tax-efficient way, how to manage things like old age security clawbacks, ways to structure your investments to support tax efficiency, and we'll also share a real-life style case study to show how small changes can lead to meaningful tax savings. Our goal is to give you a clearer understanding of how taxes impact your retirement plan, practical ideas you can apply, and a better sense of how to create a more efficient and sustainable income strategy. Before we get started, just a quick reminder, this session is meant for educational purposes and everyone's situation is a little different. So if anything resonates with you, we're always happy to have a more personalized conversation afterwards. I will also mention that there is a chat function on Zoom. So while we're reviewing things, if you do have any questions, please type it into the chat function and we'll get to it at the end of the presentation during the question and answer session. Let's begin by looking at the different types of income you may have in retirement. When we think about retirement income, it's important to understand that it doesn't come from just one place. It typically comes from a combination of sources, and each source is taxed very differently. Most retirees will draw income from three main buckets: government benefits, employer pensions, and personal savings. Each of these sources has its own rules, especially when it comes to taxation and flexibility. Understanding how each one works is the first step in building a tax-efficient plan. Government programs such as CPP, so the Canada Pension Plan, and Old Age Security, or OAS, form the foundation of retirement income for many Canadians. They provide reliable indexed income, which helps protect against inflation. However, they are fully taxable, and in the case of old age security, your benefit can actually be reduced if your income gets too high. So while they're stable, they still need to be coordinated with your other income sources. Next, if you are fortunate to have a workplace pension, that adds another layer of steady income. Sometimes these are indexed, sometimes they are not indexed to inflation. The good news is, though, that there are some advantages here, like pension income splitting, which can help reduce taxes for couples. Roughly a third of Canadians have an employer-sponsored pension, which then places a much higher burden on personal savings and managing them in a tax-efficient manner. By being strategic about which accounts you draw from and when, you can reduce your total tax bill over your lifetime. So let's explore how each income source is taxed in more detail.
So, as many of you might be aware, the RSP or RIF withdrawals are wonderful in the sense that when you put the money in, you get a tax deduction and it grows tax-free. The bad news is when you take it out, it's fully taxable, 100% taxable, just like getting a paycheck. So if you take $10,000 out of your RSP or RIF, you have to show up $10,000 on your income tax return. And as you get into higher incomes, you are potentially triggering old age security clawback and larger tax bills. Now, good news about tax-free accounts is they're wonderful because all the growth in it and all the withdrawals are completely tax-free. They don't add to your income. They don't show up in your tax return anywhere, so they have no impact on old age security clawbacks or any other kind of income tested benefits from the government. Bad news is you don't get a tax deduction when you put it in, but that's offset by the benefit of tax-free growth and tax-free withdrawals. And it's been something that we've really been using a lot since they came in with that, and trying to find that fine line between how much to put into an RSP and how much to put into a tax-free savings account based not just on current income, but what the future income will look like as well. For those old enough to qualify for it, as early as age 60 for CPP, 65 for old age security, but you can delay both of them up to age 70. And the benefit of delaying them is that you get an increase. And for those 66 2/3% of Canadians that don't have any kind of government pension, or sorry, any kind of employer pension, we often will take a look at their situations and encourage them to defer at least age 65 or perhaps even to age 70, because that will give them a higher guaranteed indexed pension to cover some of the basic essentials. Now, one of the bad news about CPP and old age security is they also show up as completely taxable income. So every dollar that you get from CPP or old age security does show up as taxable income. And unless you ask them to, they will not take any taxes off at source. Because they're relatively small amounts, they would fall individually below your personal exemption. So government says, oh, we don't need to take any tax off of this. However, if you don't, and depending what your other income sources are and how much tax you have taken and what other expenses you have, you could end up with a huge surprise at the end of the year saying, oh, you owe a whole bunch of income tax because none was taken off. Now, non-registered investments, so these are outside of your RSP or outside of your tax-free account, they're taxed annually on the investment income that you've earned. So if it's earned some interest like a GIC or bonds, it's 100% taxable. So you put $100,000 in and you earn $5,000 in GIC interest or bond interest, you have to report the full $5,000, whether it's reinvested or not. You have to pay the tax on that $5,000. If it's in a stock or a mutual fund and it's appreciated in value, you don't pay any tax on the appreciation until it's actually triggered. So if you sell a few shares or a few units of the mutual fund and you trigger some capital gains, good news is you only have to report half the capital gains on your taxable income. So let's say you had a stock and it grew by the same $5,000 that our GIC or bond did. You've got $5,000 worth of income that you triggered, but you only have to report 2,500. So that's a bonus right there. So again, it's not the rate of return that you earn necessarily, it's how much you get to keep after taxes. And dividends are great in the sense that there's an offsetting dividend tax credit, which makes them more efficient than interest income. However, the bad news on that is that you actually have to report as taxable income from dividends from large Canadian corporations. You have to increase it by 38%. So if you receive $10,000 of actual dividends, you have to report $13,800. Again, as I say, no problem for people under age 65 or that are not collecting old age security, because that doesn't have any impact. However, if you're over age 65, the old age security clawback is tested on that gross income, not after the dividend tax credit. So unbeknownst, a lot of people invest in dividends because it provides them some income. But some people, when they've got other sources of income as well, find that having dividend paying stocks in their open or their non-registered investments actually triggers old age security clawback, which is a sort of a negative side effect of that. So key is what happens each and every year. And we can see here that there's a lot of difference in how income is taxed. Well, let's go on and talk a little bit more about tax efficient withdrawal strategies. So if we can't defer it, or if we can't avoid it completely, deferring or delaying is a great tool because it allows us to compound more income and more and grow our assets greater. Now, it depends where that's growing. If it's inside the TFSA, that's wonderful because we don't have to pay any tax on it anyhow. But typically, what a lot of people do is they say, well, I don't need to take money out of my RSP. I've got till age 71 to convert it to a RIF. And that's wonderful in a sense, keeps you in a low tax bracket, but that could cause a much higher tax bill later on because you're now forced to take out a larger amount because that's grown so much more. So we often will recommend that clients start to take money out of their RSP or RIF much earlier than the required age. And because we can take out a smaller amount, we can dictate exactly how much we take out. If we leave it in an RSP, we can take out specific amounts, any amount that we want to. And that allows us to bring out income at a lower tax bracket. So, for example, if you retire, especially if one of you has a company pension, the other one doesn't, well, now we could take some money out of the other spouse's RSP to bring them up to the bottom end of the lowest tax bracket, for example, pay minimal amount of tax. Now keep that RSP smaller so when they do start collecting old age security and CPP, they're not going to be pushed into a higher tax bracket. If there's need for larger lump sums, we take a look at where to draw it from. Obviously drawing from the tax-free, and we've had occasions where a couple of times clients have had large unexpected situations where they've been required to draw out quite a large sum of money. We've been able to draw that out from their tax-free savings account without triggering any taxes. And then over the subsequent years, we've been able to take money from their open account by triggering small amounts of capital gain and replenish that tax-free savings account. So it's a combination of where we take the money from each year, how much money do you need, where can we get it to keep you in the same tax bracket that you are, and ideally keep you below the old age security clawback. So your circumstances change each and every year, tax rules change, not necessarily every year, but they change often. And emergencies pop up, your situation changes. So that's something that we review each and every year with our clients. The key thing is that we look at is how much can we take out by triggering capital gains, by taking money out of RSPs or RIF to keep you either in the lowest tax bracket if possible, especially if you don't have a company pension, or at least keep you in the same tax bracket and ensure that you don't encounter that old age security clawback either this year or in future years. So let's turn it over to Chelsea to walk us through some more of the famous old age security clawback rules.
And we say a good withdrawal strategy isn't about paying no tax. It's about paying the least amount of tax over your entire retirement, not just in any one year. So a little closing note on that section before we get into old age security. So let's talk about something that often catches people off guard in retirement, which is the old age security clawback and how your income can affect it. So you can see at the bottom of this slide here that for 2026, the net income amount where clawback starts applying is just over $95,000 per person. So old age security is a great benefit, but unfortunately it is income tested. Once your income passes a certain threshold, which we've indicated, you start to repay part of your old age security through what's called a clawback. What's important to understand is that this effectively increases your marginal tax rate. So in some cases, you're not just paying tax, you're also losing benefits at the same time. Many clawbacks happen by accident, not by design. Large RIF withdrawals are one of the biggest contributors. Then you add in pension income or CPP, and income can stack up quite quickly. Even things like selling an investment or a secondary property in one year can push income up temporarily, but still trigger that clawback. So it's often not one decision, it's how everything adds together. The good news is there are ways to manage it. We can spread income over multiple years instead of taking large amounts at once, which is some of the items that Derek had mentioned previously. And using tax-free savings account withdrawals is a big advantage because they don't obviously count towards taxable income. And for couples, income splitting can also help keep each person under the threshold. As we mentioned earlier, taking RSP withdrawals earlier can reduce the size of future RIF withdrawals. So this is one of the big strategies that we implement with our clients, leading up to, their mid to late 60s or even earlier. One thing that surprises people is that, Derek mentioned, dividends can contribute to clawback more than expected due to the gross up. So the income reported on your tax return is higher than what you actually receive. And even though dividends are tax efficient, they can still impact things like old age security if they're not managed properly. Old age security clawback isn't something we just react to. It's something we plan around. So with the right strategy, we can often reduce or even avoid the clawback altogether. Ultimately, proactive planning helps protect your benefits and ensures your income stays as efficient and predictable as possible. Derek, any closing notes before we move on to our case study?
Yeah, I just want to point out one thing that we've helped a number of clients with very efficiently. And in this particular case, or I'll think of one couple I'm thinking of, he had a very good pension. She didn't have a pension. So again, we're able to use pension splitting very well. In the earlier years, we'd eliminated her RIF and had his RIF down to a very small amount. And they had a cottage, which had quite a significant capital gain, but it was going to go to their children. And so we talked with them and said, well, if you quote, sell it to your children, but do a vendor take back mortgage, we're allowed to, you have to report however much money you received or a minimum of 20% a year over 5 years. So by doing that and the fact that it was jointly owned, we were able to spread this large tax liability from the cottage over 5 years between two people. And we were able to keep them just under the old age security clawback. So they didn't get clawed back on their old age security at all because we'd already eliminated her RIF and minimized his RIF. So there was very little coming in from that. And we had room for a significant amount of capital gains to be reported by each of them as long as it was spread over 5 years. If they'd sold it to a third party and got all the money at once, they would have had all of their old age security clawed back, at least for the 1 year that happened. So again, that's some of the strategies that we've used.
Great, thank you. So now let's look at how all of these strategies come together with a real life example. So we're looking at a couple here. They're ages 64 and 62, planning to retire next year. They've done a great job saving about 800,000 in RSPs, 150,000 in TFSAs, and about 200,000 in non-registered investments. Their goal is to generate about $70,000 per year after tax. And like many people, their main concern is keeping taxes low and avoiding the old age security clawback later on. So we're looking at two scenarios. Scenario A without any planning, which we call the default path. And then we'll look at scenario 2 or scenario B, which is proactive planning. So in this first scenario, they follow what many people believe is the safest approach. They delay drawing from their RSPs as long as possible. They avoid RSP withdrawals and instead use TFSA withdrawals. They may also use non-registered investments to fund their early retirement years. And on the surface, this can look efficient. They're keeping taxable income relatively low in the early years, but their RSP continues to grow in the background, untouched and tax deferred. At age 71, the RSP must convert to a RIF, and now they're forced to take mandatory withdrawals every year. And because the account has continued to grow, those withdrawals are now quite large. Their RIF withdrawals could easily be $50,000 to $65,000 or above per year. Then we add CPP, old age security, and any remaining income, and suddenly their total income jumps significantly, often into the $90,000 to $110,000 range. They are now in a higher tax bracket. They're triggering old age security clawback, and they're paying significantly more tax later in life. Their tax bill can exceed $25,000 to $30,000 per year in those later years. So while scenario A looks good early on, it often creates larger tax problems later when there's less flexibility. So now let's compare that to a more proactive strategy that we implement with our clients. So instead of delaying RSP withdrawals, we begin drawing from the RSP earlier at controlled levels. For example, we may withdraw $45,000 net from RSPs, $15,000 from TFSAs, and $10,000 from their non-registered portfolio. This results in a same lifestyle, so still $70,000 to meet their needs, but now it's structured intentionally. What this does is it keeps their income in a moderate tax bracket today, gradually reduces the RSP before mandatory withdrawals begin, and it allows the tax-free savings account to be used strategically as a tax-free top-up. By the time they reach age 71, RSP is smaller, mandatory RIF withdrawals are lower and more manageable, and this helps reduce total taxable income. It avoids or at least minimizes the old age security clawback, and it maintains more consistent tax rates over the years. In the early years, taxes are typically maybe, $8,000 to $9,000 annually, compared to significantly higher taxes later on under scenario A. And, while this may mean paying a little bit more tax up front, it ultimately leads to meaningful tax savings over the course of their entire retirement. So again, the goal isn't to avoid taxes today. It's to avoid overpaying taxes later. And by being proactive and drawing from different income sources strategically, we can smooth income, reduce lifetime tax, and protect your government benefits. So here's just a visual of essentially the two scenarios. So the blue one is with no planning, and the red or pink line is with proactive planning. So the no planning line at ages 60 to 70, the income is lower. So they call this a tax valley. So, you're working, your income's high, you stop working, you have low income, which is the valley, and then at age 71, it increases again. So between ages 60 and 70, the income's low because they're delaying their RSP withdrawals, and they started collecting on their CPP and old age security. At age 71 and above, there's a sharp increase, causing a tax spike, and this is caused by mandatory RIF withdrawals, stacked onto CPP and old age security, resulting in higher marginal tax rates and potentially old age security clawback. When we compare it to the red line, at ages 60 to 70, the income is higher than the blue line, but it's controlled. Early RSP withdrawals, and typically by also delaying CPP and OAS to age 70. Then age 70 comes around, the income increases slightly because now you're starting to collect CPP and old age security, but the line is flatter with manageable income, smaller RIF withdrawals, and TFSA flexibility. So to wrap it all up into one chart, let's take a step back and compare how these two approaches look over time. So this really brings everything together, from income timing to taxes to long-term outcomes. So ages 65 to 70, in the early years under a no planning approach, income often looks artificially low. That's because RSPs are left untouched and retirees rely more on tax-free accounts or non-registered assets. With a proactive strategy, we intentionally create moderate income early on. This often includes drawing from the RSP before CPP and OAS begin. While taxes may be a bit higher during this period, we're doing that strategically to reduce future tax pressure. Ages 70 to 80 with no planning, this is where we see the impact of delaying too long. Now RIF withdrawals are required and we've added CPP and OAS on top. Income becomes quite high and concentrated in these later years. With proactive planning, and income is much more balanced. RIF withdrawals are smaller because we've already drawn down some of the RSP earlier on. CPP and OAS are still there, but they fit into a more controlled income picture. For taxes, they tend to be spiky with the no planning approach. They're lower early on and significantly higher later. That often means hitting higher marginal tax rates in later retirement. With planning, taxes are smoothed out over time. We aim for more consistent, moderate tax rates instead of large spikes, and that's what ultimately leads to lower total taxes paid over a lifetime. For the old age security clawback, with no planning, because income spikes later, there's a strong likelihood of triggering old age security clawback. So not only are taxes higher, but you're also losing part of your government benefits. With better income control, old age security can often be fully or mostly preserved, and we're managing income to stay closer to those thresholds. The impact on your estate with no planning at death, the remaining RSP or RIF is typically fully taxable, often resulting in a large final tax bill to your estate. With proactive planning, because we've drawn down the RSP gradually, the remaining balance is smaller and it helps reduce the tax burden on the estate and preserve more for your beneficiaries. Ultimately, this approach is about being intentional so you can keep more of your income both now and in the future. Derek, anything to add there before we move on?
No, just the one comment I'll make is I had people comment and say, well, I don't care how much goes to tax because I won't be around anymore. But that's a little bit short-sighted in our mind because they've added an additional beneficiary in their will called CRA. And I'm sure most people wouldn't on purpose put CRA in their will. They would rather maybe name a charitable organization or some of their relatives. And that's, again, an important thing. No, you won't directly benefit by us reducing the taxes, but certainly your family will benefit, or the charities that you've chosen will benefit from being smart with your tax planning. So, excuse me, we'll talk about what we call asset location. Most of you are familiar with asset allocation, which is how much do you want in growth type investments, which typically are stocks or stock-based mutual funds because they provide greater growth over time, but they're a little riskier in the short term, versus how much in income or safety, GICs, bonds, those kind of things that provide you with some stability, but not really as much growth potential. So that's great. And we do have asset allocation, but what's just as important, if not more important, is where you put that money. So if you consider your different types of investments as buckets, so our RSPs or RIFs, they're one bucket, or tax-free savings accounts are another bucket, non-registered is a sort of a third bucket. Those are the three basic buckets that we have. We want to put money into an RSP to get the tax deduction. After that, we really don't want as much growth. We want the lowest growth investments in there, because if we put in $100,000 and grows to $1 million, guess what? We have to pay tax on $1 million, and it probably overcompensates for the tax we saved on the $100,000 that we contributed. On the other hand, we want our tax-free accounts, our tax-free bucket, to grow as big as possible because we don't have to pay any tax on it at all. And so this is where, just to use an example of a 50-50 portfolio, and we've seen situations like this where people with large accounts, they'll come and we'll see them from another institution, and they'll come to us and exactly the same investment right across the board. Their RSPs or RIFs have 50% stocks, 50% bonds. Their TFSA has 50% stocks, 50% bonds, and their open account has 50% stocks and 50% bonds. And we go, well, we agree that you should be in a 50-50 portfolio. However, how would you like to have more tax-free growth and less taxable growth, which most people think is a good idea? So we say, well, why don't we put all of your GICs and bonds, as much as we can, if that's possible, inside your RSP and RIF? Because then it's not going to grow very much. And in fact, if you're in a RIF and we're buying GICs or bonds, likely your RIF is going to start to shrink because the minimum withdrawal rate at age 72, or when you start, is over 5%, and we can't earn 5% on GICs. So your RIF will automatically start shrinking, even though it's still earning money. But what about if we put then all of the stock or stock-based investments inside your tax-free account? And here's the situation we had last year where we've been able to do that with clients. Their RIF in 2025, because it was all in bonds or fixed income type of vehicles, earned about 4 or 5%. Their tax-free account earned close to 20%. So we've now seen, by doing this, we've been able to contribute $109,000 since day one from tax-free savings account. So for clients where we've been able to do this from day one, they've now contributed 109,000. We have many clients that have well over $200,000 in their tax-free savings accounts because it's been all the growth component. Yes, some years it's gone down, and that's the risk with it. But we've also looked at it very carefully. The tax-free account is likely the last money that we want to draw on because we're trying to get taxable income out of the way while we're still alive, and especially while we still have a spouse to split income with, and we can take a lot more money out at a low tax bracket doing that. And then we use our non-registered investments, that bucket, if we have them, and many of our clients do have significant non-registered investments, we'll use that to balance it out. So in some cases, we might end up with 50-50 in the non-registered because the RSPs and RIFs are now 50-50. All of the fixed income is inside the RIFs. All of the equities are inside the tax-free account. So we've got that at 50-50. Therefore, we have to balance out the non-registered in that same way. But that's how we do the asset location, which is so important. Not in any one year does it make a big difference, but you start to add up those differences. We've actually seen a couple of cases where the individual came to us and they had more growth in their RSP accounts than in their TFSA accounts. And we think like that's totally, in the one sense, we understand it. In their TFSAs, they have GICs, which is great because you don't have to report the taxable interest from the income. But why would you have such a low paying investment inside your TFSA and have a high paying investment inside their RSP, which they're going to have to pay tax on when they draw it out? So that's, again, to us, a real important difference. We don't necessarily change the asset allocation. We keep it as to what's appropriate for the client, but we want to make sure that they pay the least amount of tax on it. And we do that by keeping the RIF and RSP growth as low as possible and the tax-free savings account as high as possible. And then with what we've got in the open account, the non-registered, which we do have to pay tax on, we try to make that as efficient as possible, where we can, tilting more towards the tax efficiency of capital gains and dividends, so more of the growth component there, if possible. Okay, anything to add on that, Chelsea?
Oh, you covered it off. Thank you.
Okay, great. So let's look at a few other tax efficient strategies for non-registered accounts. So we already talked a lot about RSPs and RIFs, TFSAs, tax-free accounts, but now you've got money in an open account. And as we said, you've got this money and you have to pay tax on any interest it earns, any dividends it produces, or any capital gains that you triggered. Now, you could trigger those capital gains yourself by selling something, or sometimes within the fund, if the manager has sold a stock and at a profit, then they will pass that on a T-slip as a capital gains dividend. You still get the capital gains treatment on it, so it's still okay that way. But for people that need to draw money, as an example, let's say you bought a share at $10 a share, and it grew by 10%, it's $11 a share. But you now want to take some money out. So what we call systematic withdrawal plans, where just like many people have contributed on a monthly basis to get their investments growing, now that it's time to take money out and be your retirement income, we turn that around and we do a monthly withdrawal, which helps us go through the ups and downs. And so the benefit is that when you sell, you're selling a specific unit, and each unit says, oh, well, we only paid $10 for this. We're selling at $11. You've only got a $1 capital gain. So although you get $11 in your bank account, you only report 50 cents of that as taxable income because $10 is return of capital, $1 is capital gain, and you only have to report 50% of the capital gain on your tax return. So it's a very efficient way of doing that. Obviously, if you've had the investments for quite a while, it might be you bought it at $10, it's now worth $20. But again, the same still applies, is that you get $20 in your bank account, but you only report $5, which is half of the capital gain on your tax return. So that's a pretty good deal to get $20 in your bank account and only have to tell the government that you had $5 worth of taxable income. There are some companies that have what they call T-SWIPs. So this would be the systematic monthly withdrawal plan on steroids. They have it arranged in such a fashion, and they've gone through all the legal beagle stuff of okaying it with CRA, that they basically consider 100% of your monthly withdrawal as return of capital. So in essence, they say, oh, you paid $10 a share for this. We're giving you back all your original principal back first. Now, what that does is that reduces your cost base. So eventually when you do sell or take a larger amount out, then you're going to have a much larger capital gain. But again, we can work with you to say, well, when do we want to trigger that? Do you have a year when it's lower? And ultimately, the capital gains, again, are only 50% taxable. And if it's a joint account, well, then you're splitting that now with your spouse, so you spread it out even further. An additional type of vehicle that some mutual fund companies have, not all, but some do, is what they call corporate class funds. So it's exactly the same mutual fund, but they can be set up as a trust whereby they pass through interest income, dividend income, capital gains, but they can set it up as a corporation. So as a corporation, corporations don't pay out interest. They pay out only dividends or they pay out capital gains. And so for open accounts, or taxable accounts, so there's a non-registered accounts, you pay tax on it every year. Interest income, again, as we remember from earlier, whatever interest income you earn is 100% taxable. So if you earn $1,000 of interest, you've got to report it as taxable income that year. In the corporate class structure, that is either deferred and kept as a capital gain, or it's reintegrated as a dividend. So the dividend, as we talked about, you gross it up, but there's a dividend tax credit. So unless you're concerned about old age security clawback, you actually end up paying less tax than you would on interest income. So it's, again, tax efficient. Not every company has those. Not every mutual fund company does. There's typically a little higher cost involved in the management of those. So again, it depends on your tax situation, whether or not those are actually beneficial or not, but certainly can be if you have large open accounts. Another option, and hopefully we don't run into this too often, but if you happen to have an individual stock or something that you bought a long time ago, or even a mutual fund that has a bad year and there's a capital loss on it, we can actually trigger that capital loss by selling that stock or switching into a different fund. If it's a mutual fund, that might be similar, but we can trigger that loss, and you've now got a capital loss to offset against capital gains, either that we've incurred that year. You can carry it back up to 3 years to recover taxes that you've paid, or you can carry it forward indefinitely to use against future capital gains. Again, we don't like to be in that position very often, but if there is, we take advantage of whatever silver lining there is. So that's tax loss harvesting. Life insurance overfunding. Now, life insurance often isn't considered an investment tool, but if you've done a good job of building up your RSPs, you've maximized your tax-free savings accounts, you've built up a taxable open account, joint or individual, and you say, I've still got money that I may not be spending, this is where we would consider buying a life insurance policy, typically a joint last to die, so it covers the two of you. Reason for that is premiums are much less. The second thing is you can put more money in there, and it actually, there's limits on it by government policy and so on, but you can actually throw a whole bunch of money into there, and it's literally like an extra TFSA, because as long as you stay within the limits, there's no tax on how much money you put into that life insurance policy. If you do need the money back for yourself later on, we can actually arrange loans against that so you can do a tax-free withdrawal of the capital. Now, there will be interest and so on that, so we have to be careful with that. But you do have a way of accessing that capital if you need it yourself. In most cases, we only look at this where we're absolutely certain that you'll never need this. And so what happens is you can put extra money in there. And what that is that goes directly to your beneficiaries as a tax-free death benefit. Not only the cash involved that's in there that you put away, but also the life insurance benefit that was put on top of that. And if you name your children or specific beneficiaries as our specific people as beneficiaries, it also bypasses probate. Makes estate settlement very simple, saves you money, provides a larger thing. One other thing that you can do with non-registered accounts, we didn't have on here, but I just thought of it because we've helped a number of clients do this. I mean, you lose control of the money in one sense, but if you don't need the money anyhow, if it's not likely you're going to need it, you can help out your children or grandchildren by gifting them money or even opening up an RESP, Registered Education Savings Plan, if you have qualified children or grandchildren, most likely grandchildren for the people that are on here. And you can contribute money into an RESP for them. They get a government grant that matches that to increase their education funding. And what it does, it reduces the amount of taxable income that you have to report because you no longer have that money. Another thing that we've started in the last couple of years, which we're using more of as well, is the first home savings account, again, for children or grandchildren that are over the age of 18 and haven't bought a first home. You can contribute to what they call a first home savings account. It's a combination of an RRSP and TFSA. If they've never owned a home before, or it's been more than 4 or 5 years since they've owned a home, they get the deduction like an RRSP, but as long as they take it out to purchase a home, they don't pay any tax on it. If they go past the extent of that, they can actually just transfer it into the regular RSP and there's no penalties. So it's a great thing. You can gift them up to $8,000 a year. Again, it helps them out. And it helps you out in the sense that you've got less investment income to report. Okay, I think I've covered that. How about you take us through an advantage or the advantage of pension splitting case study?
All right, thank you. So as Derek mentioned, we're going to look how income splitting between spouses can play a very important role in reducing taxes during your retirement. So on the left-hand side, we see the couple's income before any planning. John has significantly higher income, so he has about $97,000 per year. Jane, on the other hand, is at $46,000. So we have a clear imbalance in income between the two spouses. Now, why is this a problem? So John is in a higher tax bracket, so more of his income is taxed at higher rates. John would also have some old age security clawback. Jane, meanwhile, has unused room in lower tax brackets, and it creates an inefficiency. They're paying more tax as a household than necessary. So let's look at what happens when we apply pension income splitting. So we shift $20,000 of income from John to Jane. John's income drops to about $77,000 and Jane increases to about $66,000. Now we're not actually changing like who receives what income. This is just a switch when you're filing your income tax returns, essentially transferring some income from one spouse to the other. So now both spouses are in a much more comparable tax bracket. Less income is being taxed at higher marginal rates, and as a result, the couple pays less tax overall as a household. And importantly, as I mentioned, their total income hasn't changed. We've simply reallocated it more efficiently on their tax returns. So in Canada, we are taxed individually, but we plan for retirement as a household. By spreading income across both spouses, we can make better use of lower tax brackets. This is one of the most straightforward and effective ways to reduce taxes in retirement. Now, if we look on the right side of the slide, it shows what happens if one of the spouses were to pass away. So in this example, we have John passing away. Jane's income increases to about $102,000 due to John's survivor pension, her CPP, old age security, and larger RIF withdrawals. but there's no longer the ability to split income with anyone. Overall, the total household income is reduced due to the loss of 40% of John's pension, all of his old age security, there's no OAS survivor benefit, and most of his CPP, because Jane or anyone can only earn up to the maximum of one person's CPP. However, all of the remaining income is now taxed in only Jane's hands, so this can push her into a much higher tax bracket. It can cause old age security clawback, leaving her with a much lower after-tax income. Income splitting is incredibly valuable while both spouses are living, but it's also important to plan ahead for what happens when that option no longer exists. So by using income splitting effectively, we can reduce taxes today, but by planning ahead, we can also help ensure the surviving spouse isn't exposed to a significant tax increase later on. This is why we emphasize starting early with RSP and RIF withdrawals. Hey, Derek.
Excellent. We'll just do some takeaways and wrap ups. The one key point we want to point out as this great benefit of pension splitting on the last slide, prior to pension splitting being implemented, John would have had his old age security clawed back because he had $97,000 worth of income, which is even now, even today, is above what the limit is for the old age clawback to start at. However, thankfully, that was one great move from the government that allowed pension splitting to be split equally. Unfortunately, the surviving spouse, even though she's earning a lot less income, is going to be affected by that old age security clawback. So taxes continuously affect your retirement income. So making small, consistent decisions greatly influence long-term outcomes. On any one year, as I said, it doesn't make a whole lot of difference usually. But when you start to compound that, it makes a huge difference over time, and especially on the final tax returns. You have access to taxable, tax deferred, and tax-free accounts, which provides great flexibility in managing tax brackets and expenses. When you have your own savings, whether that be open accounts, RSPs, or TFSAs, you have much more control over the timing of the income, the benefits that you receive from that. We can help reduce tax bills now, stabilize income for the long term. And tax smart planning focuses on paying the right amount at the right time. We do everything we can to ensure that you're what we consider the optimal tax. We don't want to move you into a higher tax bracket, but if you can pay basically the same thing that you're paying now, rather than paying more down the road, we think that's a smart thing to do. So let's take a look at conclusion. Again, retirement income planning is continuous, requiring strategic thinking about income, taxes, and sustainability. That's why we spend so much time on it with our clients each and every year. We review it, all the income sources, the account balances, withdrawals that they might need, government benefits to find improvement opportunities. We work with, you work with us to create tailored financial plans, accounting for goals, family health, and risk tolerance. We keep you informed and we talk about why we're doing things. You ultimately make the final decision, but you can walk away with confidence and peace of mind, knowing that we're planning for a sustainable retirement lifestyle. So our goal really is, and this won't work for everybody because everybody's in different situations. Both couples have good pensions, and so they could be in a high tax bracket all of their life. But as much as possible, we work using the pension splitting and keeping you in these low tax bracket each and every year to take you up to, but not over, either the lowest tax bracket, the current tax bracket that you're in, keeping you below old age security clawback, and get as much money of your RIF out as we can, or triggering capital gains. We have successfully helped many clients completely eliminate their RIFs by the time they're in their late 80s. So we do need some cooperation, but you have to stick around for a few years. They've got no RIFs. They've got large TFSAs. They've got a fairly large open account now. But again, by moderating and monitoring the open account and triggering a little bit of capital gains, we now have a number of clients that when they pass away, their tax return won't look any different than it did this year or the year before, because we've leveled it out. We've taken all the high tax situations away from them, and it's now just consistently being the same old thing, boring, level taxes, no big estate tax to worry about. So, anything you want to add to that before we go to the Q&A, Chelsea?
No, I'm good. Yeah, so I will note here, we are present on social media. We have Instagram, Facebook, LinkedIn, and YouTube, in addition to our website. So feel free to check us out there. Now we'll get to question and answer session. So we do have some questions that were submitted upon registration for the webinar, but if you have any other questions, please type them into the meeting chat on Zoom. We will look at them and review them together. We do have about 10 minutes left here to go over questions and answers. So while you're thinking of some questions, I'll start with the one that was submitted through registration. So how does one tithe or donate in retirement? And this is one of the other things that we really focus on for clients with non-registered accounts with high capital gains. You can actually donate shares of your investments in the non-registered account to charity, and the government says, oh, you're doing such a nice thing. All of those shares that you just donated to that charity, you don't have to pay tax on those capital gains. We're going to completely eliminate them. So that helps in two ways. One, it helps reduce your taxes both now and in the future. And number two, it helps free up your cash flow in your bank account, as you no longer have to donate to charities through your bank account. You can now utilize your investments that you've saved and have grown over time, and now use those to donate in kind to charity.
So I'll just add on to that. The concept of tithing actually was made famous by the wealthy barber who talked about giving away 10%, paying 10% against your debts, and putting 10% away into investments to pay yourself first and then spend the rest. So the concept of tithing actually originated back in Bible times. It was giving away 10% of whatever you earn. And so the idea when you go into retirement, you no longer have a salary. How do you tithe on that? Well, to me, it's a little bit more difficult in one sense, but it's very similar. And I often use the tax return, which is not totally accurate, because as we've shown, there are some ways that you can draw tax-free income that doesn't show up on your tax return. But basically, it's talking about new income that you're earning each year. So as an example, if you put $100,000 in a GIC and it matured at $105,000, 10%, think, oh, well, if I'm going to tithe on the 105,000, that's 10,500. But no, you've already tithed on the money that you saved to get to the $100,000. The only increase you have is on the $5,000 increase. So you would pay 10% of the $5,000 that you received. So again, to me, that's the way you look at it, is look at what was my increase. It becomes a little harder if you're investing in stocks and mutual funds, because they could have an increase of 10% one year and have a decrease of 5% the next year. If you've given away 10% of the increase this year, you don't go back and ask the charitable organizations to give you a refund because your investment went down this year. So it's a little one that you sort of have to play around with and figure out and come to peace with yourself of how much to give away. But basically, it's on the increase, not the original investment that you put in, because you've already paid tax and tithed on that originally or given to charity. So that would be my additional answer to that.
Great. And the other question that we had on registration was regarding tax implications. Is there a point or return at which it is better to have 100% equity investment over GICs within a TFSA? We essentially already covered this question through our asset location slide. In our view, it's always better to have 100% equity investments in your TFSA over a GIC, just because of the long-term growth equities provide over GICs, especially these years, or this year in particular, where interest rates have gone back down. You can't earn more than like 3.5, definitely under 4 4% on a GIC these days. So would you want your TFSA only growing at 4% a year, or would you rather have them grow, equity so far year to date are upwards of 10%? So, and that in a terms of a return point of view, definitely equities in your tax-free account.
Yeah. I'll just add two caveats to that. One is, and we've had clients in situations like this where they knew they were going to have a large expense and they had relatively small open accounts. So we wanted to put as much as we could in the tax-free savings account, but we earmarked a specific amount that we knew that they were going to be withdrawing in the next 12 to 24 months into a GIC or into just a money market fund. So we knew that it would be safe because, again, it's partly what's the time horizon. For most of our clients, the TFSAs, as Chelsea alluded to, is we've got RIFs or RSPs, we've got open accounts that we can draw on that we would choose to draw on first. We leave the tax-free as the last possible source to draw from. But if we know that we're going to need to draw from it, we will compartmentalize and put a portion there for the shorter term that we know we're going to draw out in something safe. The second caveat is if you've got a very low risk tolerance and you only want to have 30% in growth investments and your TFSAs are 60% of your portfolio, we obviously wouldn't want to, we would put all of the growth in the tax-free account, but then we would have to buffer it with whatever fixed income GICs to keep you at the proper allocation for your risk tolerance. Any other questions?
Yeah, that's all the questions that we have right now. Obviously, people that are attending, feel free to reach out to us, give us a call at the office, send us an email. This webinar has been recorded and will be posted on our YouTube page and our website. So if you didn't catch it all, you can certainly rewatch it. And we're always here as a soundboard to bounce any ideas off. So feel free to reach out to us.
Thank you all for joining us. Have a great day.